So today I'm going to talk about 10 stocks that are down over 70%. So at the moment, as you're probably aware, we're in a bear market. So with this bear market, we have a lot of stocks down mass amounts. And I found this list of random stocks. There's a lot of stocks on there, more than 10. So with this bear market, as you would expect, there's more than 10 stocks down over 70%. But I had a look through this list and thought, you know what, I'm going to pick a random 10 stocks and talk about them stocks and if they're potentially a buy, where I'd potentially buy them, if I still wouldn't buy them, either avoid. But obviously in a bear market, you are gifted so many opportunities, and today I thought let's have a look at some of those opportunities. And like I said, there was a lot more than 10 stocks on that list. I randomly picked 10, but I could easily get another 10 if this series is popular and do it once again, so let me know. So we're going to get started. So number one is Etsy. So obviously I'm pretty sure most of you guys would know what Etsy is, but it's an e-commerce site. At the moment we know a lot of e-commerce stocks are getting hurt massively. Etsy is a bit unique to the normal e-commerce site, so it's a lot more based around handcrafted products, single and made products, unique products, and a bit more of that kind of industry of the e-commerce site. A lot more crafting compared to the likes of Amazon, which is obviously selling mass amounts of the same products basically. So yeah, I definitely think it's got its unique point here that is a lot different to say something like an Amazon, for example. And I think that this sort of area in particular will carry on doing very well going forward. So yeah, I think it's a very interesting company. The share price is getting kind of towards where it was pre-CV situation. So pre-CV, it was around that $50 mark. It is at $80. It is a 10 billion market cap company, so it's a pretty smaller kind of mid-sized company. It does make a profit though, because it does trade at 26 times earnings. And when you do look at the past performance, you can see this kind of boom when the CV situation happened. So without doubt, even now, I mean, Etsy's still growing at really good rates. It's just that it's not growing as what it was because it's had so much demand pulled forward from the CV situation, which is totally understandable. So I think it will still grow good amounts of profit and revenue growth in the future. I think it's just having a cooling off phase, as a few e-commerce sites are when you've had this massive surge at the moment. So yeah, good amounts of profit, good amounts of revenue growth. I think the little niche it has here is very interesting. It's a stock that I actually would potentially buy. The only one concern I have with the likes of an Etsy is its balance sheet. By the way, if you want to sign up for this program that I'm using right now to show you, there's a link in the description. If you sign up on the 5th day, you'll actually get a 30% discount code. So just to let you know, it's Simple Wall Street. It's a fantastic platform. And you can see here through Simple Wall Street, the debt to equity. My little problem that I have seen with Etsy is that over the last 2 years, the debt has ramped up quite a bit, which is the little bit of a negative. So with Etsy, I think it's a good company. I think it's going to be very successful. The growth is good. Like I said, the only concern is the debt. For me, I wouldn't mind buying Etsy at $80. I think though, with the debt that is there, I think I would have to be talking, pre-CV prices to get me interested. I think if we're talking $50 and then Etsy at the moment, obviously is nowhere near the same company as what it was, the pre-CV situation. I think that what might potentially, get me across the line. Not gonna lie, if it had a stronger balance sheet, I would potentially have bought this one already. So yeah, that's the only thing that's kind of stopping me from Etsy, but I think this is a good one to be looking at. Next one is Zoom. So Zoom is a bit of a funny one because I think Zoom, people say like it doesn't have a moat, which I can understand because it's, video conference calls basically, which it's not hard for obviously Microsoft or Facebook to kind of get in here. However, with Zoom is that it's got the kind of brand name. So, when you say, oh, I need to know something, or you Google it, that kind of thing. With Zoom, it's very much, oh, we need to do a, save us from traveling. Let's do a Zoom call. It's kind of got that tied down now. And as much as, Apple or Facebook or Microsoft might try push into this area, I think Zoom has got a massive advantage in here at the moment and tying that down. So even though you could say it doesn't have a moat, at the same time, I kind of think it does have a moat. And as well as that, without doubt, Zoom conference calls have had the major benefit that what they could ever have, because it's kind of like it's showing everyone how to use it, installed it, and at the end of the day, people, even if we do go back to a office environment, people are going to actually consider, oh, you know what, rather than me traveling all that way for that meeting, why don't we just do it on Zoom call? And even though the CV situation has helped them, and sure, in the next 12 months that will also affect them a bit in a negative way, in the longer term the CV situation has massively helped Zoom and taken it a lot more mainstream than what it would have ever been able to achieve, you know, without the CV situation. So yeah, it's a bit of a funny one. It's had a boom, it's had a bit of a bust, but in the long term I still think there's room for, you know, video conference calls, and especially Zoom. You know, same again, you know, it's had a massive surge in profit and revenue, and I think it will still keep decent amounts going forward. My only issue with Zoom is that it's, you know, not near where it was pre-CV once again. Even though I don't think the valuation's crazy, I don't find it attractive enough for me to justify not buying the stocks that I really like, and, you know, kind of, you know, not buying them and then putting that into Zoom. I'd rather buy the stocks that I currently own. So for me to kind of consider Zoom and put that capital maybe into it, I would have to see it maybe come down to that, you know, pre-CV levels of $70. So that's Zoom. Next one's Netflix. We mentioned this one, I think, previously on the channel, actually a while ago. So we have mentioned this one, but it's not a regular feature on the channel. With Netflix, I'm not a big Netflix fan. I've never, since I made the channel, if you follow the channel for, you know, 1 year, 2 year, 3 year, 4 year, 5 year, it's crazy to say that we've been doing videos that long now, but, you know, if you followed me on the channel for a long time, you know I'm not a big Netflix bull. I don't think the moat is great. I think that they've had it their own way for so long, and finally they've had competition, and I think that's really hurting them right now. And as well as that, they have really tough comps. So yeah, I think that it's really hard because they've got to try and make a lot of their own unique content at the moment, which is tricky. They're not doing too bad at it, but I still think there's a way a far way for them to go to kind of get to the level of a Disney, for example, and that's why I prefer something like a Disney. However, I've got to say with Netflix, even though I'm not a big fan, at some point you do have to look at Netflix and go, $196 at the same share price it was at, you know, 2017. There's a point where you have to be interested in it. And I think it is very close for Netflix. I think that if Netflix was to maybe slip down to that $130, $140 range, I think that would be potentially the really interesting point, which is where it nearly got to be fair to it. So, it is tempting, you know, it's got its main show, Stranger Things, coming back up. Sooner rather than later, user growth will go back in the right direction. And it's like anything, you know, if someone comes to you on the street and says, you know, I've got this 2-year-old car, for example, and I pay $10,000 for it. You know, you might not need a car, you might not want a new car, and he goes, you know what, you know, it's worth, you know, $10,000. I'll sell it to you for $8,000. You know, you're thinking, well, I am going to make I'm going to be up $2,000 for it, but is it worth it buying that car? You know, I've got a car I like, you know, even if I want to sell it on and make some quick money, it's the hassle of, you know, taking it in and selling it again. But eventually if that guy goes, okay, well, will you have that $10,000 car for $6,000? Then you're thinking, well, either way, you know, even if I don't want this car and I'm going to resell it on, it's worth $10,000, so I'm stupid even for a bit of work. I'm going to make some good money on it. And it's same with like investing in stocks. You know, I might not be the biggest fan of Netflix, but even if I'm not a big fan of Netflix, I can realize that Netflix is, you know, a stock that should be worth a lot more if it goes down to crazy valuations. So yeah, I might not be the biggest fan, but as always, every kind of company has a undervalued amount on it, and there's always a point where you will be willing to buy, and I think Netflix is quite close to that. You know, I think if I said maybe you're not a fan of Netflix at 190, maybe it's at 140, 130. If it's not there, if I say Netflix, you can have it at 80. There's an amount I keep dropping down to if I go 60-40, you know, where you'll say, okay, that's where I buy Netflix. So that's where I am with Netflix. I'm not the #1 fan, but there's always a number where I'd be probably willing to buy it. Next up is Coinbase. Coinbase went through a major boom. I mean, look at that, but look at the future. It's not looking too good for it. Coinbase is a platform where you can buy and sell cryptocurrencies. For me, this is a massive avoid. I'm not a big fan of crypto. And the second is, what is the unique point about Coinbase? There's plenty of platforms where you can buy and sell crypto. I think it's very hard to be very unique in this area. And also, the asset that they sell, I don't think has a amazing future as what everyone makes out it to be. So for me, this is an easy one for me. It's a major avoid at the moment. Lyft. Lyft is down obviously a massive amount, over 70%. Obviously these guys do taxis, very much like an Uber, for example. If you look at the company, it's starting to kind of benefit from the economy reopening back up. However, when you do look at Lyft, they're still losing plenty amounts of money. I think there's a lot of competition out there at the moment. There's not really too many unique or remote in this kind of sort of industry either. So I'm a bit worried about that. I'm a bit worried that profitability will probably be a bit of a nightmare until there's some kind of consolidation in this kind of space. And the big thing as well is because they're losing money and they're not making profit. In the last kind of 2 years, this debt is starting to catch up with them with a little bit, and unfortunately it looks like as they continue to lose money, either that's going to go through share offering or even more debt. So yeah, Lyft is probably not one I want to be touching. Affirm. So Affirm is actually one that I was interested in a while ago. So this is a buy now, pay later service, and they were really advancing very well in this kind of space. Unfortunately, it seems like Affirm in the last 12 months, for me, haven't been progressing as much as what they could have been. And what that has led now is it's led a lot of the other companies to kind of catch up. So that kind of Affirm and another kind of rival, which is Klarna, they kind of had a really good first mover advantage on this. Unfortunately, the likes of PayPal, for example, have been really catching up to them in the last 12 months. I think their buy now, pay later is growing something like 400%. Something like a Square have bought Afterpay. So with this sort of company here, I was quite bullish on it a while back. Unfortunately, it's been slow to keep progressing, and I feel like the companies in this space, the fintech giants, have been very quick to catch up to them, quicker than what I thought. So I would not justify buying something like Affirm when you can go out and buy Square and PayPal that has the more complete moat, and won't burn through as much money as an Affirm. So yeah, this is one I'm a bit more had a bit more of a turnaround in the last 12 months. I would say that there's probably better companies to be buying in this sort of space than this one at the moment. Next one is Unity. So Unity is a software company that helps video game software developers. Now, a lot of people have been raving about this one. I remember since it came on the stock market in 2020, there's been a lot of rave reviews about this stock and the potential of it, and that's obviously been on the share price as it went to, over $196. And I've always looked at it and gone, I mean, I don't know how that it's at this sort of valuation. Like for me, even right now, I think Unity is massively overvalued. So this is one to avoid for me. When you look at the company, it trades at such a rich valuation. It's 12 billion, and they're only doing nearly 1 billion in revenue. They're burning through mass amounts. Half of the revenue goes to burning through cash, and when you're burning through that many cash, there's a big massive hike up on the debt. They do have enough cash to survive for quite a while, but there's at no point looks like moving towards profitability here. So yeah, the balance sheet's getting worse. They're nowhere near moving towards profitability. They're burning through a lot of cash, and in my opinion, even right now after this major drop, it's a massive rich valuation. The thing I also have to consider is that I would have to do a lot of research, because I'm not one of these stock YouTubers that kind of just what seems very popular at the moment is just putting a stock into a discounted cash flow calculator and going, oh yeah, that's an absolute buy. It doesn't work like that. I think that you do have to have a valuation and run numbers and see what they potentially could be valued at in the future. But the one major catalyst that you need to be remembering of is, why is that stock going to do it? Why is that business going to grow revenue and profit? That's the key thing to understand. You've got to understand the company and how they're going to drive profit and revenue forward. With Unity, I'm not very much in the kind of gaming software space. So I would have to learn the competition, what makes them unique, what's the selling points. So for me, I can't even justify doing any research straight away looking at this company, because I can't do my bull thesis, because I look already and go, don't like the balance sheet, don't like that it's not going to make profit in the next 2 years, don't like that how much money they're burning through. So this is a massive no for me. Next up is Roku. So Roku is actually one of the stocks that's actually gone back down to pre-CV prices, which is kind of scary. And same again, when you look at what they've done in the last 2 years, it's nowhere near the same company that it was kind of 2 years ago. It is making profit now. It is making good amounts of revenue. However, it is forecast to go back to being unprofitable. Now with Roku, it's a bit of a streaming service where it kind of bundles in everything together, so you don't have to have different streaming services. So I think this has potentially a good future. I think that obviously as they continue to develop, they could grow revenue, get that profitability up. My only worry really with this kind of company is the moat. Once again, potentially can it lose because it uses sometimes external providers. What happens if these external providers want to move away from Roku, or is there going to be a new trend that kind of catches on and everyone moves to that supplier? So I'm a bit worried about Roku because of the moat and what it uses externally. However, you talk about a company back at pre-CV prices, which is not too bad at all. So especially when you look at the progress. So I do like this one. This is probably one of the more favorite ones that I do have on the list. However, same again, I just can't justify buying it at the moment. I mean, once again, it would have to come down a bit more for me to be interested in it. But I don't think the valuation is ridiculous as some other ones on here. But it's probably one more of my favorite ones on here, but personally for me it's not the right valuation to buy. Next up is Rivien, so an EV player. Obviously EV players came to a lot of hype in 2020, 2021. I've kind of kept it on my watch list because I potentially think they could have very interesting plans going forward, and their aims, if they can deliver on their aims, it's going to be very interesting to watch. I'd say the problem with Rivien is that they're still so early stages. I mean, potentially we could finally get to a year where we actually make some decent amounts of revenue and hike that up. But even then, the money that they're potentially going to be losing is massive amounts. Now, obviously, they do have a very solid cash balance at the moment. I mean, I think, 16 billion of cash they're sitting on. However, they are forecast to burn through nearly 6 billion a year, which is a lot. So they've got a few years run rate. However, I think this is it's one that I'm watching. However, I think that it's when you're talking 26 billion and it's still this kind of early stage, I can't even take like a high spec punt at it. It's just this is still really, really early stages, and when you look at what's valued in already, I can't touch this one at the moment. However, I think they've got interesting plans. I'll keep watching it, but this is just way too early for me. I personally would not touch this one at the moment, and if I was, I couldn't touch it at 26 billion. I think if I was to be if I was ever to take a really small high risk position on it, I'd have to buy in that at a market cap of 10 billion. So I still think this is quite high. And the last one on this list is Chewy. So these sell pet products, and the thing is even in a recession, people still will spend good money on their pets, a bit like a family member. And it has had a massive decline on the share price. However, the company is still performing okay. When you look at the company, sure, gross margins were down as a lot of shipping issues kind of carry on and everything like that. However, the company is still slowly moving in the right direction, and when you look at the benefit that the share price has had in the last few years, massive amounts of revenue increase, and also starting to move into that path of profitability. So I think Chewy is definitely one to kind of keep watching, and I'm kind of interested in it. My only problem with Chewy is that they do have razor thin margins, so 26% gross margins. So trying to turn that to profitability can be a bit of a nightmare. The competition that is out there, I'm not sure how well brands hold up in the pet industry. If you had certainly, when you're talking about these gross margins, the only industry that's quite similar is kind of like the kind of food and drink, like the food and beverage space. Those are the only companies that have probably gross margins down at these sort of rates. And when you talk about them sort of companies, you can kind of justify, you can see why people are willing to go spend that money on that certain food brand, because if it's a product they really enjoy, they'll keep getting that, and there's that kind of moat and that loyalty here. With pet products, I don't know what could potentially stop an owner from going to Chewy and then going to another brand, because will they notice the difference in switching or something like that? So that's the only little worry that I do have with this kind of company. It's not high up on my priority list, but I don't think it's a terrible company. I would like them to try and make better amounts of profit if possible. I don't know if they'll be able to do that. I certainly don't think they'll be able to do that through just selling the kind of products of the actual, you know, toys and food. I think if they wanted to make better gross margins in the pet space, would have to move more to probably like insurance side of it, maybe more, you know, medication side of it. That's probably where I would guess the better margins are, and maybe the business is good. They are trying to move in that direction. I don't really know it that well, so I can't say too much on it. But yeah, that's what I'd say on that one. I think it has to move a bit more into profitability at the moment for me to be interested in it, to kind of consider, you know, buying that one. So yeah, I hope you enjoyed these 10 stocks that are down 70%. If you could, hit that like button. If you're new, subscribe, and I'll see you next video.